Okay, so welcome to part 2 of this video on the 20 Buffett lessons that has made me millions. Now, before I continue, let me remind you to watch part 1. If you've not caught part 1, go watch part 1 and I'll come back to part 2. So in part 1 of the video, I talked about how when I first started investing at the age of 17, I had no idea what I was doing. I was more of a gambler than an investor, and I made all the mistakes that most investors make at the beginning. So whatever money I made in the short term, it didn't last. I would lose it again. I made the money, I lose it again. So I went in circles for easily over 8 years. And it was when I started watching all of Buffett's lectures on video. I read all his annual letters that I understood his perspectives towards investing. And it changed how I invested. And it helped me to build my own framework for investing using his principles. And that allowed me to consistently beat the S&P 500 over the long run. So for example, you can see since January of 2019, over the last more than 6 years, my portfolio gained 228% versus the S&P 500 that gained just over 140%. So that's a compounded annual return of about 21% a year. And I owe this result to, again, following Buffett's principles. So there are many principles that he teaches. So in this second part of the video, I'll be summarizing the 20 key principles that I follow every day in my investment decisions. Okay, so principle number 1, which I learned, is to only buy wonderful businesses at fair prices. So first of all, understand that when you buy a stock, you're not buying a lottery ticket where you're trying to predict that the stock is going to go up next day, next week, next month, next year. You hope the stock won't go down. No. When you buy a share of stock, you are buying a piece of a business. Always remember that. So I use the word stocks and businesses interchangeably. So when you think of stocks as pieces of businesses, it changes your perspective. You're no longer a gambling person, a gambler. You are a business owner. So think of yourself as a business owner, okay? And we only want to buy wonderful businesses. So one of the things I learned is that in the stock market, in the US market, there are over 10,000 businesses for sale, 10,000 stocks. And 99% of them are not great companies. They are mediocre or lousy companies. So I'm only interested in buying the top 1% of all the companies. And we call them the wonderful companies. So wonderful companies are companies with very strong fundamentals. So what does that mean? They meet certain criteria. Number 1, they've got very consistent growth in revenue, earnings, and free cash flow. They got high return on capital. So, for example, I look at return on equity and return on invested capital at least 12% or more. And most importantly, we look for companies that have got durable competitive advantages that protect them from competition. So competitors are not easily able to take away their customers and their market share. So Warren Buffett calls this an economic moat. So we want to buy companies with strong economic moats. So these are companies that have got very strong brands that give them pricing power. These are companies that have got economies of scale, that have got high customer switching costs, that have some kind of protection against competition. So that's the first principle. So as a result, you find that for myself personally, I avoid 99% of stocks that people talk about. So many of the stocks that people talk about on social media, they say, oh, this stock is going up, this stock is going up. And people get all excited. To me, I'm not interested. If it doesn't meet my criteria of a wonderful business, which is the 1%, okay? So that's the first principle. Being disciplined to only focus on wonderful businesses and ignoring the mediocre or the lousy or the uncertain businesses. Number 2 principle is that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This is a very common mistake many investors make. So a lot of investors, they make the mistake of buying a stock because it looks cheap. And one of the things I've learned is that cheap crap is still crap. So most importantly is to make sure you only buy high quality companies. Valuation is important, but it's not as important as the quality of the business. So in other words, I rather buy a high quality business that is slightly undervalued or fairly valued than a mediocre business that is very undervalued. So always go for quality. And I'll give you a few examples. So one of the most obvious example is in the semiconductor industry, semiconductor business. So NVIDIA is by far the highest quality chip maker. And a lot of people I know, they bought Intel instead over the last 2, 3, 4 years. Why? Because Intel looked cheap, right? Whereas NVIDIA looked expensive. But for me, I bought NVIDIA, I avoided Intel because I knew that Intel, no matter how cheap it looks, again, cheap crap is still crap. And when you buy a mediocre or lousy company, it's really hard to perform. But when you buy a high quality company, even if you pay a bit more for it, it is worth it because that will compound your wealth over the long run. So look for quality first, valuation second. Okay, third principle is Warren Buffett's favorite quote, which is, he says, I've got 2 rules to investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Now, please do not get the wrong idea. It doesn't mean that every stock pick will make money. That's impossible. So I said in part 1 of the video that even Buffett himself has bought many stocks that didn't work out well, that he cut loss, it went to zero. Same for me. I've got many companies I bought, well, not many, a couple, right? Estee Lauder, Disney, and Boston Beer that I cut loss at 30, 50, 60% below my purchase price. So you will have losing companies. So what he means by this is at a portfolio level. So what he's saying is that if you buy a portfolio of great companies, where again, a great company is one that consistently makes more money every year. And again, the problem with a lot of people is they go for speculative companies that don't make money, or they promise that one day we're going to make money, but we don't make money now. These are companies that Buffett avoids and I avoid myself, right? Because these are companies where the stock price is built on hype, is built on narratives, is built on fantasy, which may come true, some of them, but 99% of 100, they don't come true, and these stocks go to zero eventually, okay? So when you buy stocks that actually make money now, that make money consistently, where the valuation is supported by current earnings, not just fantasy, and you buy a group of these great companies, collectively, it's impossible to lose money if you hold them for the long run. Yes, in the short term, companies like Amazon, Microsoft, Meta, Coca-Cola, American Express, Visa, MasterCard, in the short term, they can go down because of market volatility, right? But over the long run, they will always go higher. Why? Because in the long run, McDonald's always makes more money, MasterCard always makes more money, Microsoft always makes more money. So when you hold a basket of these companies, in total, it's impossible to lose money collectively. So that's what he means by this statement. So buy a portfolio of great companies. So don't put all your money into one stock. That's insane. No matter how great you think a stock is, never do that. Always divide your capital into minimum at least 8 to 10 great businesses so that collectively it's impossible to lose money. That's rule number 3. Rule number 4 is one of the most important traits of investors is patience. And I can tell you that just by taking a long-term perspective, whenever I invest in a stock, I always take a long-term perspective of at least 3 to 5 years minimum, okay? And most people can't do that because most people are, I want to make money now, I want to make money fast. They're very short-term focused. And the moment the stock doesn't perform in 1 day, 1 week, 1 month, they get out, they buy something else, they're like jumping all around. And simply by having a long-term perspective and not being affected by the short-term volatility, this gives you a significant edge in the market over the majority of people. This alone will allow you to beat 99% of the so-called investors out there who have got a short-term perspective. So Buffett's famous quote is that the stock market is a device for transferring money from the impatient people to the patient people. And it's all about being patient. You gotta allow the stock you bought, the business you bought, you got to allow it to compound and, 3x, 4x, 5x over time. Many people, they want quick money, so they bought NVIDIA at $15 back in 2022. This is the post-split price. They bought at $15. At $20, they're out. Because impatience, they want to make money fast. But now Nvidia has gone up close to 10 times or close to 9 times at $130. And I'm still not selling because I'm holding for the long run, allowing that compounding effect. Okay. Number 5 is if you don't understand it, don't buy it. And again, this is something that a lot of new investors, they can't follow because they have this FOMO, the fear of missing out. Everyone is talking about hims and hers. I got to get into hims and hers. Everyone's talking about Grab. I got to get into Grab. Everyone's talking about this stock. I got to get into this stock. So they chase every stock that looks like it's going up. So, Buffett's very different. And the interesting thing is this. If you look at Warren Buffett never invested in Google. He never invested in Microsoft. He never invested in Nvidia. He didn't invest in Palantir. He didn't invest in Tesla, right? So you can say that he missed all these great stocks that went up a lot. But does he care? He doesn't care. And the reason he didn't invest in all these companies was because it's not within his circle of competence. It's not something that he understands because he admits that he's not someone who understands technology, right? So he buys things he understands. So he understands oil and gas. So he buys Occidental Petroleum. He understands consumer goods businesses. And to him, Apple is not a technology company. Apple is a consumer goods business. So he understands that. So the lesson again is that you don't have to win at every stock. You don't have to be in every stock. You don't have to win at every game. You just have to win at the game which you understand. Same thing for me. There are many stocks that I don't buy because it doesn't fit my investment criteria. And yes, many of these stocks I didn't buy went to the moon, right? Even like for myself, so I as you guys know, I don't buy crypto. I never bought Tesla. I never bought hims and hers. I never bought Grab because they don't fit my investment criteria. It doesn't mean that it can't go up. Of course, it can go up. And if it goes up, it's fine. It's great for those who bought it, but for me, it doesn't fit my criteria. Yeah. So again, think about it. Buffett has missed so many stocks, and yet he makes billions every year. So you don't have to chase every stock. Invest in what you understand. And again, the amazing thing is that I follow Warren Buffett's principles religiously, but it doesn't mean that I buy whatever he buys. There are many stocks that Buffett buys that I will never buy. Why? Because I don't understand some of his stocks. Like again, I never bought Occidental Petroleum. I never bought Sirius Holdings, which he bought. I never bought American Express. I never bought General Motors. I never bought many of the insurance companies that he bought. Why? Because I don't understand it. It's not my circle of competence. But I bought Amazon, I bought Meta, I bought Microsoft, I bought Nvidia, I bought Palantir, I bought Booking, I bought Mercado Libre, which he never bought because I understand that. You get the point? So buy what you understand. And we are all unique. We all have our different strengths of competence. And it doesn't matter how wide your circle of competence is. What matters is you stay within your circle of competence. And that takes a lot of discipline. Okay, so let's move on. So those are the first 5 principles. Okay, principle number 6 is on timing the buy. So the first 5 principles is what to buy, right? What to buy. Now we look at when to buy, okay? So lesson 6 is what he says, his quote, be fearful when others are greedy and greedy when others are fearful. So we know that the way to make money is to always buy low and sell high. Okay, now easier said than done. Most people buy high and sell low. Why? Reason is very simple. When is a great business cheap? A great business is cheap when no one wants it. When it is hated by people. When it's out of favor. Right? When people are fearful about it. When it's hit with all kind of bad news. So you want to buy a great business when it's hit by bad news. But you got to make sure that the bad news is not fraud, okay? The bad news is some short-term cyclical headwinds or short-term deceleration in growth or short-term problems that doesn't affect the long-term competitive advantage of the business. So we want to buy when there is market panic. We want to buy when the market has a correction, when it's got a bear market. That's the best time to buy. But for most retail investors, that's when they sell, because they panic, they sell, right? So we want to buy when everyone is panicking. And if we want to sell a business, the best time to sell is when it's at a high. And when is it at a high? When everyone loves it, when everyone wants it, when there's euphoria in the markets. So the way to make money is to be a contrarian, to go opposite of everyone else. Number 7, price is what you pay, value is what you get. So we want to buy a great company when its stock price goes below its intrinsic value. So you got to learn how to calculate intrinsic value. That's why in my investing course, my whale investor course, I spent a lot of time on valuation. So remember, a business is a money-making machine. The more money it makes, the more it is worth. It's as simple as that. So in other words, the value of a business or a stock depends on how much money it can make. So intrinsic value is always calculated from projected future cash flows. The trouble is a lot of people, they guess where the stock is going based on market hype. They think that, oh, because it keeps going up, it's going to go even higher. But they don't look at the cash flow. Or they look at where the stock is going to be based on analyst target prices, which a lot of times is full of bullshit, right? So you got to always value the company, again, not based on hype, based on does it actually generate the cash? Yeah, so that's why I use a discounted cash flow valuation model when I calculate intrinsic value. That's something which I do all the time. I teach in my courses. Okay, number 8, the best time to plant a tree was 20 years ago. The second best time is now. So what this means is that don't obsess over perfect timing. You know, the trouble with a lot of people is that they will say, I want to buy when a stock is at the bottom. The problem is you can never know where the bottom is. And if you always think that it's going to go lower, you end up never buying. So the important thing is, as long as it's undervalued, that is the time to buy. It doesn't mean it's the bottom. No one can predict the bottom. So after you buy a stock that's undervalued, it can go lower. Of course it can. And there's nothing wrong with that. There are many times I buy a stock, it goes even lower. Nothing wrong with that. Because as long as you buy when it's undervalued and it goes lower in the short term, doesn't matter, because eventually it will get back above the intrinsic value. So one of the things I learned is that when I invest in shares of a stock, I never go all in at one go. If I want to buy 100 shares, for example, I'll buy 25 shares first. And then I buy another 25 later, right? So I always average in my position because I know I can't always pick the bottom. Yeah. Neither can you sell at the top. No one knows where's the top. As long if you want to sell a company because you want to reinvest in something else, then you sell it when it's overvalued. And you don't sell all at one go. You sell again in tranches. You buy in tranches, you sell in tranches. Next, when to sell, which I actually preluded to. So again, whenever I buy a business, I always have this intention that I want to hold it forever. In fact, if you buy a great business, you never want to sell it. Seriously, I'm not kidding. If you buy a great business, you never want to sell it. That's when you know you've got a great business. But why? Why? Because a great business is one that keeps on compounding your wealth over time. Then you may say, but if you don't sell it, there was a point of owning it. Okay? True. Okay? So the only time you want to sell a great business is when you need the cash to buy a new house, to buy a new ring for your girlfriend, for your children's college education. So basically, you sell it only when you need the money. But if you don't need the money, you stay invested, let it compound. So Buffett says, I rarely sell winners unless the business fundamentally deteriorates or I need the cash for something else. So as long as it's a great business, it keeps growing, we stay invested. Number 10, if the business does well, the stock eventually follows. So don't sell a stock just because it dropped in the short term. That's the dumbest thing you can ever do. Unless, of course, you are a short-term trader. But I'm not talking about trading here, I'm talking about investing, which is a different philosophy from trading. Trading is a one-night stand. In trading, when you enter, you got a stop loss. Once it hits the stop loss, you get out. That's trading is a one-night stand. Investing is kind of like a marriage, okay? So when you invest in a great business, you don't sell based on short-term price swings. You sell only when the business no longer grows, that is losing its competitive advantage, or you realize you've made a mistake in the business. Like again, I realized I made a mistake buying Disney, buying Estee Lauder, buying a Boston Beer. So I sold it, I reinvested it in something else, and that has grown my money, okay? And I give you an example, right? So many of you know that I bought many Chinese stocks years ago, and I've held all of them till now. I've not sold a single Chinese stock except Tencent. And I sold Tencent I think it's about a year and a half ago right now. Okay? And at the time, the reason I sold Tencent was not because the stock price dropped. I never sell because of the price movement. I sell if I feel that the business is no longer predictable. And I sold Tencent when I realized that at the time the Chinese government was coming out with all kinds of regulations that Tencent can't sell their games because it didn't meet certain nationalistic principles. And I realized that I don't want to own a business that doesn't have the freedom to generate profitable games, right? And so I sold Tencent. And then some people say, oh, Adam, you're an idiot because you sold Tencent at the bottom, and after you sold it, it went up. Now, first of all, after I sold Tencent, I took the cash. Did I put the cash in my bank? Of course not. The moment I sold Tencent, I immediately reinvested that money in another business that was just as great or better. So I sold my Tencent, I reinvested in stocks like Nvidia, like Palantir, like Broadcom and stuff like that. So sure, after I sold it, Tencent went up and the Chinese government changed their policies, which of course I can't predict, and Tencent went up, and it's fine, right? But did I lose out? No, because that money I reinvested in my Palantir, my Nvidia, that went up even more than 10 cents. Okay, so remember, it's okay to sell a stock, and after you sell the stock goes up. That's fine, as long as you reinvested in something else that goes up even more. Okay, another good example is United Health, which just happened recently. So I've been holding United Health for quite a few years, and I decided to sell it last week. When they were accused of fraud, of coming up with a lot of fictitious billings. And now I realized that, and I wrote a whole letter to my students, and I told them that, you know what, United Health is too big to fail. They will recover from this. And I've got no doubt that the stock price will go back to new highs. I've got no doubt, but you know what? I'm selling anyway. You know why? Because I'm personally not comfortable owning a business that has got a culture of systemic fraud, in my opinion. I'm not comfortable with it, right? So anyway, so I sold my United Health shares, all my shares, I sold it for a slight profit because I bought it very cheap. So I sold it for a slight profit, and I immediately reinvested it in other companies. So I bought Novo Nordisk, I bought HCA Healthcare, I bought Pooh Corporation, and I bought ASML. So I reinvested everything immediately. Okay, now, when United Health rebounds and goes back to all-time highs, did I lose out by selling now? No, because I reinvested it in other companies that I believe would perform even better than United Health over the long run. And these companies I feel comfortable with because, well, at least for now, there's no evidence of systemic fraud. Okay, so remember, there's nothing wrong with getting out of a business you're not comfortable with, whether is it at a profit or loss, as long as you reinvest it and that new company you invest in can remake your returns or give you even better returns in the future. Number 11, one of his quotes is that I buy on the assumption that they could close the stock market the next day and not reopen it for the next 5 years, and I'm fine with that. So again, he doesn't focus on the short-term market moves. He looks at where the business will be in 5 to 10 years, and selling for quick gains isn't his game. And that is something I realized. Now, when I first started in the markets, I used to do more short-term trading. I go in, I go out, I go in, I go out. And I found that the money I made was very small money. It's when I started investing for the long run where I saw the big money. I saw the millions of dollars. And that's why today you have got many billionaire investors, but there are hardly any billionaire traders that you hear about. All right, so number 12, the weeds wither away in significance as the flowers bloom. Ooh, I love this. I love this quote. I let winners like Apple, Geico, American Express grow while small losers fade in impact. Focus on the big picture, not every single stock or trade that you make. So this is something I talked about more in the first part of this video, where one of my winning stocks, like one of my Nvidias, one of my Metas, one of my Palantirs, they go up 5x, 8x, 10x, and they make my losing stocks like Estee Lauder, Boston Beer become insignificant, right? So that's why you must let your flowers bloom and your weeds will become insignificant. Should you find yourself in a chronically leaking boat, energy devoted to changing vessels is likely to be more productive than energy devoted to patching leaks. So in other words, cut losers fast once the business model is broken or compromised. And this is something, again, I talked about much just earlier on, right? Why I sold United Health, why I sold Disney and Estee Lauder. Once I found that, the moat is not as strong, I'm out. And I invest in a company immediately with a very strong moat to make it back and a lot more. Next, the most important quality for an investor is temperament and not intellect. So again, in part 1 of the video, I mentioned that why I gravitate towards Warren Buffett's way of building wealth is that you don't have to be a genius. You don't have to have an IQ of 130. You just need an average IQ. You just need common sense. Because in Buffett's own words, he says that his genius is not his intellect, it's his temperament. So it's your ability to manage your emotions, to stay calm with both winners and losers. Don't get upset when your stock goes down. Don't be happy when your stock goes up. Think rationally. Panic selling and greed-driven buying ruins your game. Principle 15, and this is referring to news. Now you find that the majority of retail investors, they get obsessed over news. What is the Fed going to do? How is the war going to affect my investments? How is Trump's tariffs? How is the election going to affect? The greatest investors like Warren Buffett and Charlie Munger and Peter Lynch, one of the things I've learned from them is to totally ignore the macroeconomics, yield curve and GDP inflation. All that is purely for entertainment. It's purely for entertainment because all these things are unpredictable. They are uncertain. No one can predict interest rates, where they're going to go. No one can do that, right? So instead, focus on the businesses. So in the short run, the market is a voting machine. So where the stock goes in the short run is all based on emotions and hype and sentiment. But in the long run, it's a weighing machine. In the long run, the stocks that go up eventually are the ones that actually make money consistently. And those are the things you can look at from the company's financial statements. Those are knowable. So ignore the daily news noise. Things like inflation, the Fed, what the Fed is doing, and instead focus on the weight of the company. Easier said than done. Most people find it hard to do. They get distracted all the time. So in my community, I keep reminding my students, ignore the news. Ignore the news, focus on the business. Next, predicting rain doesn't count. I mean, if you guys know, the best weather machines can't predict the weather. Same thing, the best stock forecasters can't predict the next recession. They can't predict the next bull market. No one knows until it happens. So it doesn't count. But what counts is building arcs. So Buffett always says, I don't forecast recessions. He doesn't forecast the market. He just buys businesses that can weather any storm. So as long as you buy, again, a portfolio of great companies that can do well in any economic situation, high inflation, low inflation, recession, no recession, that's how you make money. So we are not in the prediction business. I keep telling my students, we're in the business of building bulletproof portfolios. But 17, American businesses have done fine over time and it will continue to do so. Macro gloom doesn't sway me. I bet on the US economy's resilience and not short-term news headlines. So again, one of the principles I follow is that the US stock market will always go up in the long run. Since it started over 120 years ago, it has always gone up. Why? Because US companies are the most globalized in the world. And over the long run, corporate earnings grew at 8% a year on average. If you add in share buybacks and dividends, that's why the stock market over the long run, through the ups and downs, through bull and bear markets, will compound at about 10% a year if you simply buy the S&P 500 index. But if you learn to pick the top 1% of businesses, the way I do it, the way Buffett does it, we're able to beat the index by a wide margin by compounding our wealth at 19-20% returns a year or more consistently. If I can do it, you can do it. It's a matter of following these principles. Right, last 3 lessons. Lesson number 18, volatility is not a measure of risk. Now, a lot of people, they look at market volatility, prices going up and down, and they define it as risk. Or the market drops, is very risky and all that. But people like Buffett, they don't see short-term price movements as risk. They look at the business. So let me give you an example. During COVID-19 in 2020, Microsoft stock dropped 30%. And most people would think, oh my God, that's risky because the stock drops 20%. But people like Buffett and myself, we look at the business itself and ask ourselves this question. During the COVID period, did Microsoft, their revenue and profits actually drop? No, it didn't. In fact, Microsoft's revenue and profits went up during the pandemic. Why? Because in the pandemic, people work from home, they still got to use Microsoft. They're still paying the subscription fees, right? So from the business perspective, Microsoft had no risk. It had no risk, right? And if you take a long-term perspective, you know that the short-term drop in the stock price, the 30%, was nothing to be afraid about. It was an opportunity to buy shares of this great company that had no risk at a 30% discount. That's the difference between the Buffett investor and the speculator and the gambler. So again, Buffett says, I see market drops as opportunities like buying stocks in a crash. They are not a threat to my core holdings. So it's really interesting. For example, in the last 3-4 days, the market has been going down. And some people have been posting on my social media saying, oh Adam, how much money have you lost? You've got such a big portfolio, you've got millions in stocks. Have you lost a lot of money? I'm like, I have not lost shit, right? Why? Because all the companies I own are great companies. They make more money every year. And even though their share price may drop temporarily, I have not lost anything because I'm not selling shit. I don't sell anything. So to me, the short-term price movement is an illusion, right? It doesn't matter to me if the stock price drops 20, 30, 50. It doesn't matter to me, okay? Because I'm holding the great companies. And I know that in a month, in 6 months, in a year, in 2 years, they'll be at all-time highs again, So that's the difference. Number 19, the stock market is designed to give you chances to buy at silly prices. So like, that's what I mentioned. So there are times when, a Microsoft drops 30% and is a great company selling at a silly price. That's when you scoop up to buy these undervalued gems. And you got to be patient to wait for those times to pounce on these opportunities. Okay, last one, number 20, is ultimately your psychology. Remember, is investing risky? Yes, if you don't know what you're doing, okay? So risk comes from not knowing what you're doing. Risk comes from incompetence. But if you know what you're doing, like me, okay, like Buffett, like my students, then investing is no longer risky. Investing is no longer risky. In fact, the riskiest thing you can do is to keep cash and to not invest. Because if you keep cash and you don't invest, then you're guaranteed in 10, 20 years because of inflation, right? In fact, if you get 3% inflation a year, in 10 years, your wealth, your purchasing power would drop 27%. And in 10 years, your purchasing power will drop 27%. In 20 years, your purchasing power, your wealth will drop 46%. And you're guaranteed that by the time you can't work anymore, by the time you have to retire, you can't. Because you don't have enough money to survive in a developed country with higher prices. Okay? But if you learn how to invest in a very safe way, then that is what gives you ultimate freedom. So study businesses relentlessly, sleep easy, and let time compound your wealth. It's been a pretty long video. Thank you for being with me, for staying with me this long. I hope you got something out of it. And I can tell you that these 20 principles changed my life. And I do hope you'll change some of yours. Thank you. Leave a comment. I'll see you guys in the next video. May the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.